Hello, my name is Megan McBride Kennedy, and this is my presentation on the accounting cycle. Step 1, starting with the beginning account balances. In this step, it is important to check for accuracy and to catch incorrect or false information. So what is an account? An account is a detailed record of all increases and decreases that have occurred during a specific period. All accounts will fall under one of the main categories of assets, liabilities, or equity. In accounting, there is a cool equation to check for the accuracy and organization of accounts. The accounting equation is assets equals liability plus equity. An asset is an economic resource that is expected to benefit the business in the future, or something the business owns or has control of that has value. I'd like to add that the value is in a dollar amount. Main asset accounts include cash, accounts receivable, which is when a customer pays on credit and owes the company cash, supplies, property, plants, and equipment. Accounts are tangible assets that aid in the production of goods and services. The next part of the equation are liability accounts. So liabilities is a debt or something the business owes. So something usually being cash, product, or services. When it is a product or service that is owed, it can fall under an unearned revenue account. Liability accounts will often include the word payable, as in accounts payable or notes payable, service payable. An accrued liability account might include taxes payable, rent payable, and salaries payable. Accrued means the expense has happened, but the cash has not yet been paid. So far, we have discussed asset accounts and liability accounts. The rest of the accounting equation is equity. Equity is the stockholder's claim to the assets of the business and is also called stockholder's equity. Stockholder equity is made up of contributed capital or common stock and earned capital. Earned capital results from the selling of goods and services or revenue, as well as the cost of selling goods or services, expenses, and the distribution of those earnings, called dividends. Dividends are paid out to the shareholders. Dividends and expenses are subtracted from the right side of the accounting equation. Because they are money that is paid out, in order to keep the accounting equation balanced, asset accounts are debited, and when drawing a simple T account, the debit side is always on the left side, just as assets are on the left side of the equation. Although dividends and expenses are on the right side of the equation, they must be debited accounts because they are always subtracted. The other liability accounts and equity accounts are credit accounts because they are on the right side of the equation and increase when credited. There are exceptions which will be briefly explained in later steps. Accountants must determine which accounts are affected by which transactions. At the end of step 1, we have started to organize the accounts, or at the very least, we have unadjusted account balances. And now for step 2, we gather the journal entries to know what accounts we must analyze in order to balance the accounting equation. We do this by using a double entry accounting method. Every transaction will impact at least 2 accounts. One account is debited and the other account is credited, which will make sure the accounting equation remains balanced. We will need to create a chart of accounts. Companies need a way to organize their accounts. A chart of accounts lists all of the company's accounts along with the account numbers. Here is an example of journalizing and posting entries. This is actually an example of adjusted entries, which will come later in the accounting cycle, but I like this journal because it shows the double entry system really well. If we look at the bottom entry, we see unearned revenue, which is a liability account and will decrease with a debit, while the service revenue is an equity or revenue account and will increase with a credit. The explanation says to record service revenue earned that was collected in advance, which means the company performed a service or incurred revenue without collecting money up front, and this adjusted entry was made when the money was collected. Step 3, posting journal entries to the accounts and the ledger. In addition to a chart of accounts, companies need a way to show all of the increases and decreases in each account along with their balances. So companies use a ledger, which is a collection of all of the accounts, the changes in those accounts, and their balances. A chart of accounts and a ledger are similar in that they both list the account names and account numbers of the business. A ledger, though, provides more details. A ledger will include balances and increases and decreases of each account for a specific period. It also will use a double entry system to balance the accounting equation. Every transaction must be recorded in at least 2 accounts. For example, when a stockholder contributes money in exchange for common stock, the 2 accounts involved are cash and common stock. At the bottom of the screen, you'll see the T account, which is a shortened form of an account in the ledger. The left side of the T account is called the debit side, and the right side is called the credit side. Most asset accounts have a normal debit balance. Dividends and expenses also have a normal debit balance because they subtract from the liability and equity side of the accounting equation. All other accounts on the liability and equity side will have a credit balance. Step 4, prepare the unadjusted trial balance. Periodically, throughout the time period, the company will prepare an unadjusted trial balance. This is a summary of the account balances from the ledger. After all transactions are recorded and posted, a trial balance is prepared. We can see at the bottom that the debit and credit sides are equal, which means the accounting equation is balanced. If this was not the case, it would indicate there has been an error in recording the process. For step 5, we need to establish that the business is using an accrual basis accounting system. There are 2 primary ways to record transactions: cash basis accounting or accrual basis accounting. Cash basis accounting may be fine for some smaller businesses that are not public, therefore they do not engage in common stock or lending of goods and services, which means they wouldn't have an account such as accounts receivable. Cash basis accounting records only cash transactions. When cash is received, revenues are recorded. When cash is paid, expenses are recorded. Cash basis accounting is not allowed under the Generally Accepted Accounting Principles, or GAAP. Having to prepare adjustments means the business is an accrual basis accounting. Accrual basis accounting follows the GAAP and records each transaction as it occurs. Revenues are recorded when earned and expenses are recorded when incurred. All right, still in step 5, journalize and post adjusting entries. So this unadjusted trial balance lists the revenues and expenses, but these amounts are incomplete because they exclude some revenue and expense transactions. Accrual basis accounting requires that businesses review the unadjusted trial balance and determine whether any additional revenues and expenses need to be recording. The adjustments are needed to calculate the net income or loss on the income statement, as well as assets and liabilities on the balance sheet. So there's 2 main types of adjusting entries. First, deferral: cash is paid or received before the related expense or income is recognized. Second, accruals: expenses or revenues are recorded before the cash transaction takes place. Prepaid rent is an example of a deferral. Another adjustment would be depreciation. So property, plant, and equipment are long-lived tangible assets used in the operation of a business. As a business uses these items, their value and usefulness will decline, and as they decline in usefulness, they must be tracked as an expense. This is called a depreciation. The expected value of a depreciable asset at the end of its useful life is called residual value. Because of the length of time a plant, equipment, and land asset will remain usable, a contra account must be created to balance the accounting equation while keeping track of the depreciation expense. So a contra account is paired with and is listed immediately after its related account in the chart of accounts and its financial statement. A contra account's normal balance, debit or credit, is always the opposite of the normal balance of the related account. Because of the cost principle, we need to keep the original cost of the asset separate from the accumulated depreciation. Accountants can then refer to the original account to see how much the asset originally cost. After step 5, we are ready for step 6, the adjusted trial balance. The adjusted trial balance summarizes the account balances from the ledger, and its purpose is to ensure that total debits equals total credits. Here's an example of a worksheet that includes an adjusted trial balance. This so far has been my favorite way that I've seen from the textbooks to organize information. So the section 1 is the account names. Section 2 is the unadjusted trial balance. Account balances are copied directly from the ledger before any adjustments. Total debits must equal total credits here. Section 3 is the adjustments, and Section 4 is the adjusted trial balance. This gives the account balances their adjustments, so each amount in these columns is calculated by combining the unadjusted trial balance amounts plus or minus the adjustments. Step 7, preparing the financial statements. Financial statements should be prepared in this order. Number 1, income statement. It reports the revenues and expenses and calculates net income or net loss for the time period. This is done by taking revenues and subtracting the expenses. Number 2, statement of retained earnings. It shows how retained earnings changed during the time period due to net income or net loss and dividends. Finally, 3, the balance sheet reports assets, liabilities, and stockholders' equity as of the last day of the time period. The financial statement will exclude service revenue and expenses and dividends. Step 8, journalize and post closing entries. The closing process happens at the end of the accounting period. It involves recording and posting closing entries to prepare accounts for the next period. This process clears out revenue and expense accounts to show net income for each period. It also updates the retained earnings balance with the net income or losses and any dividends paid to shareholders. Closing entries move the balances of revenue, expenses, and dividends to the retained earnings account. Permanent accounts such as assets, liabilities, common stock, and retained earnings are not closed at the end of the period, and their balance is carried to the next period. So step 1 of the closing process. Seen in the first pair of journal entries, the revenue account will need to be debited its full amount to then equal 0. The closing entry transfers total revenues to the credit side of the income summary account. Step 2, next compound entry will transfer the expense accounts by debiting the income summary account for the total of all expense accounts. Expense accounts will be zeroed out with credits. This will transfer total expenses to the debit side of the income summary account, which will subtract from the credit side of the income summary. Step 3, to close the income summary account and to have it equal 0 by crediting the retained earnings account and debiting the income summary account. This closing entry transfers net income or net loss to the retained earnings account. The last step, step 4, the very bottom entry, the dividends account will need to equal 0 by debiting the retained earnings account. This entry transfers the dividends to the debit side of the retained earnings account because dividends decrease retained earnings. Last step, step 9. After closing entries are recorded and posted, the accounting cycle ends with a post-closing trial balance. Only assets, liabilities, common stock, and retained earning accounts or permanent accounts appear on the post-closing trial balance. Therefore, there are no temporary accounts like revenues, expenses, income, summary, or dividends. They all have been closed. The retained earnings account has been updated to reflect the period's net income or loss. The ledger is now up to date and ready for the next period. We also see at the bottom that The debit side is equal to the credit side, which means the accounting equation assets equals liabilities plus equity is balanced. Accounts are also listed assets first, then liabilities, and then equity accounts. That is it for the accounting cycle. Thank you. I am out of time.